Nuestro siguiente conferencista es Whitney Tilson. Whitney es fundador y managing partner de T2 Partners y de Tilson Mutual Funds. Además maneja 3 sociedades de inversión privadas. Es coeditor del Value Investor Insight y fundador del Value Investing Congress en los Estados Unidos. Whitney escribe de manera regular columnas en el Financial Times. Es invitado regular de CNBC y de otras cadenas financieras. Es un gran analista y profesor y ha realizado recientemente uno de los mejores análisis sobre la crisis hipotecaria, publicando diversos artículos y un libro recién publicado que se llama More Mortgage Meltdown, 6 Ways to Profit in These Bad Times. Whitney obtuvo su MBA en Harvard. Agradecemos mucho su presencia e interés. Adicionalmente, Whitney cada año, bueno, es el segundo año que comparte sus experiencias con nosotros y es quien da el taller de Advanced Value Investing que fue ayer. Whitney, thank you very much. Welcome.
Good afternoon, or should I say good evening. It's good to be back, and thank you, Paco and Alejandro, for inviting me back and organizing such a wonderful conference. It's great to see how it's growing. Just out of curiosity, show of hands, how many people were here last year? Okay, lots of you. So you may recall last year, I'm going to give you an updated version of the presentation I gave last year. It was a year ago May, so it was more than a year and a half ago, just about a year and a half ago, and it's hard to imagine how much has happened in that 18 months. At the time, I gave a presentation focusing on the U.S. housing market. I predicted a calamity. A calamity is exactly what we got. I went back and actually looked at the 2 stock ideas I recommended. Berkshire Hathaway, which remains one of our largest positions, and I shared my analysis of it yesterday at the workshop, is down about 20%, almost exactly in line with the market. I'm more proud of my short idea, which was Washington Mutual, which fell 100%. That was a very good short. So I'm back with another long idea, another short idea, but what I'd like to start with is to bring you up to speed on the U.S. housing market, the U.S. employment situation and economy that sort of provides a framework for why, as investors, we are playing defense today, whereas 8 months ago, we were playing offense. One of the earlier speakers, and Tom Russo highlighted it, said that, things go in cycles, and as an investor you have to adapt. Well, the cycles are moving very rapidly these days, and gave you one of the world's best opportunities to short stocks 18 months ago, one of the best opportunities to go long stocks 8 months ago. And today we're somewhere in the middle. It's a tough environment to find long ideas, but we're finding a few good ones, and we're also finding a lot of good short ideas. So with that as background, let me just start with a quick overview of the U.S. housing market. It's the world's largest debt market. In the United States, 56 million homes have mortgages totaling $11 trillion of notional value. And it's broken into 3 general categories. About half of the mortgages in the United States are owned or guaranteed by the government entities, Fannie, Freddie, the FHA, and the VA. And then about a third are held on the balance sheets of banks and thrifts and financial institutions. And about 15% were sent to Wall Street. And this was the so-called securitization machine that I detailed yesterday in my analysis of MBIA and why we're short MBIA, where the people originating the loan didn't care if the homeowner defaulted because they were just selling it to someone else, often within a matter of days, and then were just collecting a fee. And that went on all the way through the process, all the way to the Wall Street firms that were simply bundling up all these toxic mortgages, selling them out to the institutional investors of the world with virtually the entire pool of mortgages blessed by the ratings agencies with a AAA rating. It was a doomsday machine, and that's exactly what we got, doomsday, from this kind of system. And it's not surprising that those 15% of mortgages are the worst mortgages and are the ones that defaulted first and are really the ones that at least blew up the world financial system, at least initially last year. So this is overall number of mortgages in the United States. Of those 56 million mortgages, 1 out of 7 is now in some stage of delinquency. And depending on the type of mortgage, the delinquency rate varies dramatically. Everyone here is probably familiar with what a subprime mortgage is, a mortgage to someone with a very poor credit history, generally a low-income person who's never paid a bill on time in their life. and not surprisingly, giving those mortgages, nearly half of those mortgages have now defaulted in generally only 2 or 3 or 4 years after they were written. The next line down, I don't know if I can get a little mouse here. The next line down, this blue line here, that a year and a half ago, there were no defaults, is now up to almost 30%, are option arms. These are adjustable rate mortgages generally given to better borrowers, but they had super low, they were mortgages where you didn't just have to pay the interest, it was better or worse, depending on your point of view, than an interest-only mortgage. You could pay, for the first 5 years, sometimes even 10 years, you could pay 2% interest on an 8% interest rate loan, but every month you made that low interest payment, the interest you should have paid, the 6% difference, is added to the balance of the loan. So these loans, the balance of the loan is going up, called negative amortization, while the value of the asset, the home, has been going down. And as these loans start to reset and people no longer are able to just pay the 2% interest rate per month, virtually all of them default, and that's exactly what we're seeing. The next type of mortgage down here, the yellow line, which is sort of following the same trajectory as subprime for a very good reason, many of the same characteristics, are Alt-A loans. Alt-A is a category of loan that's between prime and subprime. Generally a little bit better borrower, a little bit better credit history, better FICO score, but for some reason it wasn't prime. Maybe a somewhat blemished credit history, but not a terrible credit history. But the most common reason is that it was a low documentation, no documentation, stated income. There are various names for it, but basically what it meant is that the bank or the lender was willing to make the loan without bothering to verify the borrower's income or assets. Now that may sound a little crazy to you. Why would anybody ever lend money to someone without checking to see if they had the means to make the interest payments, much less repay the loan? But that's in fact exactly what happened with millions of loans in the bubble. So the Alt-A loans, 80% of these loans are what are now called liar's loans. Why? Because everyone was lying. If you don't ask borrowers to show their income or their assets, I assure you they will all lie. So you have a little bit better borrower, but much worse fraud than subprime. And so it's following the same trajectory as subprime, but about on a 2-year lag basis, because most Alt-A loans reset in 3 to 5 years. Most subprime loans reset in 2 years. So the last thing I'll point out down here, these other types of loans, prime loans, et cetera, down here at the bottom, they have much lower default rates, but from a much lower base. So they're still rising rapidly as well. So let's talk about when we try and predict how many mortgages are going to default going forward. Keep in mind, 14% are defaulted, but 86% haven't defaulted yet. And the key to trying to figure this out is to figure out, well, what are those other 86% of people going to do? Well, one thing to understand is that homeowners in the United States have been very rational throughout this bubble. What did they do as home prices doubled from 2000 to 2006 in the United States, and lenders were willing to lend against virtually anything? They took money out of their homes. Americans use their homes as cash machines. And so how do you take money out of your home? If your home doubles in value, how do you actually take the cash out? You can do it in 3 ways. One, you can sell the home. Some people did that. 2 is you can refinance, do what's called a cash-out refi, which is you simply take out a new mortgage up to the appreciated value of the home and then collect the cash. Or the third thing you can do is what's called a home equity line of credit. You just borrow against the appreciated value of the home. And Americans did all 3 of these things to the tune of at least $2 or $3 trillion. Big money. They took cash out of their homes. So now what has happened as home prices have fallen by about 30%, as Americans, as more and more people go underwater on their mortgages, meaning the home is worth less than the amount of the mortgage, Americans are sending the keys to the banks. They're walking away from the homes because it is economically rational for them to do that. So as a group, homeowners have been very rational, and it would be prudent to assume that they will continue to be rational. So let's take a look at this particular chart, and let me tell you what it shows you. The dark bars here, these bars here show that this is California mortgages, first liens. So this isn't a second mortgage on top of first mortgage. So this is a first lien, directly collateralized by the home. All mortgages in California in 2006. So this isn't subprime or Alt-A or option arms. This is all mortgages written in California, the largest market in the United States, in 2006. And by January 2007, Let me skip back here. You can see that the black bars here show that the average the average loan here was $150,000 in the money. So what does that mean is it means the home had a value of about $500,000 and there was a $350,000 first lien on it. So the homeowner has skin in the game. They're $150,000 in the money. And then from 2007 through today, as home prices collapsed by nearly 50% in California, the average loan written back in 2006 declined. The amount of equity in the home declined and declined and declined as home prices fell. And today, the average loan written in California in 2006 is now $150,000 underwater. Okay, so homeowners who bought or refinanced their homes in California 3 years ago at the peak of the bubble, almost all of them are now deep underwater due to the collapse in home prices. So what are homeowners doing? That's the blue line. This is the default rate on this axis. And homeowners, very few of them defaulted when they have skin in the game. And then when they go underwater and start going deep underwater, they all start defaulting. And now, as of today, about 50%, half the mortgages in California in 2006 are today in default. Sort of sobering numbers. So if this were only a subprime problem, it would long since be behind us. It would be a contained problem. The problem is this was not a subprime bubble. It wasn't even a mortgage bubble, a residential mortgage. It was a bubble, a global debt bubble that infected nearly every category of debt to one degree or another all over the world in many cases. And so you can see that subprime here is about $1.5 trillion. But there are many other categories of loans that are also experiencing high default rates. Alt-A is a $2.4 trillion category. Commercial real estate is $3.5 trillion. So there are a lot of areas where financial institutions that own lots of different types of loans, a big bank like Wells Fargo or B of A or Citigroup will hold billions and billions, in some cases hundreds of billions of dollars of every single one of these types of loans. Now subprime is probably the worst along with option arms, but in all of these loan categories, losses are higher than they're at unprecedented levels. So one of the ways this crisis is shifting is it's shifting. Initially, it was the subprime loans that defaulted first because you had the weakest borrowers and the loans reset in only 2 years. What we're seeing now is though that the better loans, Alt-A, were a little bit better, and particularly prime loans. These are loans where the borrower put 20% down. They were documented to good borrowers with good credit histories. Prime loans are generally where everything was done properly, yet these loans are still defaulting. Why is that? Well, it's not because of any payment shock due to interest rate resets, because most of these are fixed rate loans. It's due to a terrible economy, very high unemployment rate, and people being underwater. So subprime, this crisis is shifting from primarily one driven by subprime loans defaulting, and you can see that they've sort of leveled off, whereas prime and Alt-A are now the new types of loans that are now driving defaults. So big picture, foreclosures have been rising rapidly. You'll notice, though, the last few months, foreclosures seems to have, from very unprecedented high levels, seem to have declined a little bit. Before everyone starts thinking that this is great news, however, this is mostly due to the implementation of the Obama administration's foreclosure mitigation plan, where they're giving banks and servicers financial incentive not to foreclose and instead to do loan modifications. So that's temporarily reducing the number of foreclosures, but most of these loan mods are going to fail. This chart was pulled out of the Wall Street Journal just a few weeks ago, and basically it shows the darker the red, the more foreclosures and delinquencies there are. And what you can see is that yes, this crisis is concentrated in Florida, California, Arizona, and Nevada, but that it's started to spread all over the country. This is no longer a 4 or an 8 state problem in the United States. It's becoming increasingly a national problem because unemployment is and people being underwater are national phenomenons. Big picture, what do we think is going on is that the first 2 waves of losses, which is the fraud and speculation and then subprime, is mostly behind us. But what is still ramping up in terms of being problems are prime loans. The chart I showed you a few slides ago, both prime loans that were sent to the government and that the U.S. taxpayer is going to be on the hook for, but also prime loans that weren't sent to the government, weren't sent to Wall Street, that banks still holds, like jumbo prime, second liens, HELOCs. And then lastly, wave number 5 is loans that aren't even related to the residential market: commercial real estate, credit card loans, auto loans, student loans, commercial loans, construction loans, all those other loans I showed you. Most of those losses will be borne by the U.S. banks as well. So you might look at this and say, wow, the wave number 1 and wave number 2 blew up the world a year ago. And wave numbers 3, 4, and 5 are bigger. Those are much bigger categories of loans. So are we predicting that there's another Armageddon ahead of us? And the answer is no. And there are a couple reasons for it. Number one is that while the loans may not have defaulted yet, banks have started to take reserves against future losses. So some of the write-downs have been taken, even though the losses haven't yet hit. The IMF a few weeks ago came out with an estimate that the U.S. banking system has taken write-downs equal to about 60% of the total losses. So the United States is working its way through this crisis. When I presented here a year ago, the United States, the banking system was maybe 10% or maybe 20% of the way through the crisis. Today, 18 months later, we're 60% of the way through the crisis. So that's good news. We are working our way through this. The other reason, though, and it's a very important reason why that has implications for investors, is the initial losses happened suddenly, and banks blow up and financial systems blow up, not just from big losses, but from sudden losses. Because if losses come in over a long period of time, banks can earn profits every quarter and fill the hole. It was for those of you who were at the seminar yesterday, this was what I was explaining with Wells Fargo. It's true of our entire financial system as well. So the losses, the initial losses, the subprime, the stuff that was sent to Wall Street happened suddenly, and that's caused a shock to the system that caused an investor panic, blew holes in banks' balance sheets, and blew up the world and required big U.S. government intervention to save the financial system. The losses going forward, the last 40%, are likely to come in over the next 4 or 5 years, the bulk of it, not the next 1 or 2 years. And that's going to give our banks time to earn their way out of trouble. So there's good news in that I don't predict any shocks to the system that cause a major crisis. The bad news, though, is that the U.S. banking system is going to be facing high loss levels, unusually high loss levels, albeit declining over time, but still abnormally high, I'd guess, for the next 5 years, because there's still so many loans that bad loans that are going to need to work their way through the system. And therefore, that's going to be a headwind. Banks are going to be reluctant to lend to small businesses to create jobs, et cetera. Our general, it's one of the reasons we think that U.S. economic growth is likely to be feeble. Not necessarily negative, it may not even be characterized as a recession, but it might be 1% economic growth, not 3% economic growth, which is what you might expect after a downturn like the one we've had. So, in the housing market, housing sales have rebounded, in part due to affordability. Interest rates are very low, housing prices have fallen a lot, and also lots of government stimulus. And that's helped bring down the supply of inventory, the reported supply of inventory. But there's something very important to keep in mind here. The inventory they're reporting here of 7 months, this is the National Association of Realtors, is only homes listed for sale. And they're between the time a homeowner defaults and starts missing 1 payment, then 2 payments, then 3 payments on a mortgage, and the time a home is actually listed for sale and sold, often that can be a 2-year process on average. And therefore, what this is missing is that there are lots of homes at some stage of default that are not yet listed for sale. So what is the real inventory? Because that's what we really care about. Well, what this shows is this shows the monthly rate. The upper bar here shows first-time defaults of new mortgages, and then the lower bar here, and let's see, there's this green bar here shows new defaults, loans that have never missed a payment, that miss their first payment. Now, that doesn't necessarily mean they're all going to default, but these days, when people start missing 1 or 2 payments, most of those loans are going to default. If a loan today misses 1 payment, it's 72% likely to go all the way through to foreclosure and lose the home. If a homeowner today in the United States misses 2 payments, they're 95% likely to lose the home. And if they miss 3 consecutive payments, they're 99% likely to lose the home. So then at the end of this whole process, so the whole pipeline of housing inventory starts when someone misses a payment and ends when the home is sold off after foreclosure and real estate owned and the home is sold. Well, look at the difference here. Every month that the defaults here are higher than the liquidations, that's the sale of the home, means that the number of homes in the inventory pipeline is growing. So we're still a long ways away. Right now, there's a big inventory overhang, but very importantly, it hasn't stabilized. It's still growing. So that means there's a big housing inventory of homes that are going to be coming through this pipe for a number of years, and it's one of the reasons that leads to our short idea, which is being short home builders, companies building new homes. This is what I'm showing you right here is very bad news for anyone building new homes, because you're going to be competing against millions and millions of homes coming through the foreclosure pipeline for the next number of years. So how many homes, how big is that inventory overhang today? Well, let's stop and step back and say 14% of all U.S. homes right now are in some stage of delinquency. And then you apply, depending on what stage of delinquency they're in. So if you break down, this number's 13.5%, but last month it's now 14%, so it's a little bit higher today. That's about 7.5 million mortgages right now are in some stage of delinquency, 14% of 56 million mortgages. And then here are the ones that have missed 1 payment that are 30 days delinquent, and those are 72% likely to go through to foreclosure. And here are the ones that are 60 days delinquent that are 95% likely, et cetera. So you simply multiply what stage of delinquency they're in by the likelihood that they go all the way through the pipe. And what it tells you is of the 7.5 million homes right now that have missed at least 1 payment, 7 million of them, almost all of them, are going to go through the whole pipeline. So there's 7 million homes in the pipeline that aren't being counted by the National Association of Realtors, which is out there only counting homes that are actually for sale. The homes in the pipeline aren't yet for sale. So 7 million homes is more than a year's worth of inventory. It's about 14 months of inventory. So